people have asked about how should they structure their businesses in a way they get access to the capital gains tax discount. And there's a second question to that. And as a small business, what are the capital gains tax concessions?
Yeah, this is a very good question, Dinesh, and can have a massive impact. And the law on this also changes as well. So it's important we stay on top of it. We've got specialists here, Grant Thornton. I'm not a tax specialist, but I got specialists in my team who look at this area, right? And I've got a couple of war stories as well that I can talk to. But the general principles, a couple of quick principles. One is the CGT discount is 50%. So if you've held an asset for more than a year, then you get the 50% discount. So you buy an asset for $1 million, you sell it for $2 million, you made $1 million profit, but you're only paying tax on $500,000, which is really good, because we used to have indexation, and indexation was frozen and replaced with the CGT discount. And again, the governments have looked to tinker with it, but as it currently stands, we still have the 50% discount. And then more importantly, the small business CGT concessions came in. I can't remember exactly what year it was, but probably in the 90s, late 90s, yeah, but I can't remember, Sandy, I'm not sure exactly when. The idea is that when a business owner, a small business owner runs a business and then they sell their business, they're reaching retirement age, and there were some concessions to encourage them. And as you said before as well, Dinesh, the small businesses are the engine room of the economy. We want them to grow and thrive and employ people and so on, but also there's a lot of sweat and tears that goes into running a small business, and to give them those concessions. And there's 4 concessions. I'll talk briefly to them. And again, I say we need to look at the individual circumstances, because the law is complex in this area. And if you get it wrong, then you're in trouble, because you've got to pay your concession back. But one was what we call the 15-year exemption. So I used this one, I remember a long time ago, soon after I came to Australia, I think it was around the year 2000, where a lady had been in business, and she had been in business for 15 years, and she sold a cafe, which was close to the Opera House, I remember, and she was just on that 15-year mark. So effectively sold it for $1.5 million tax-free.
Gosh,
yeah. Happy days, right? So we met all the tests, and she was able to get that. The second one is what we call a 50% active asset. So if you're running a business that's an active business, in addition to the small business CGT discount, you get another 50% discount. So you're paying tax on, I was saying, a $2 million gain, not on $1 million, but you're paying on 500,000, which is pretty good as well, depending on your marginal rate. Then there was something called the retirement exemption as well, which said that if when you retire and you sell your business, and as part of selling your business you retire, then depending on your age, if you're under 55, you had to contribute that money into super, and there was a cap of $500,000. So you could put $500,000 into a super fund. If you're over 55, Dinesh, I'm 40 something, so it doesn't apply to me. But so then you didn't have to, right? And then the final thing was a rollover, which was a rollover relief that was built into the small business CGT concession, which said if somebody's running a business, and this happens with our entrepreneurs, a lot of our tech startups will do a business, they'll sell it, and then they'll do the next business. So rather than pay capital gains tax at the point of selling your business, you're rolling it over onto the next business, which allows you to keep those dollars and invest in the next business. So those are the 4 concessions. I think they're great concessions. They do encourage small business, right? But there are some eligibility criteria, which I don't want to go into in detail, because it can be, we've got to make sure we tick all the boxes. But the general eligibility criteria is around either an assets test or a turnover test. So to be eligible, your small business has to be less than $6 million in value, right? Or have revenue of less than 2 million. I think that revenue number needs to be increased, right? But at the moment, we're stuck at 2 million. And then there are some rules around who is eligible, who is a stakeholder, who is a CGT concession stakeholder, who is an associate, and so on. So there are some rules. If husband and wife are running a business, they're obviously associates. We look at the combined value. But when you look at the net asset value, we exclude the home and the super fund. So your principal place of residence and your super fund are excluded. So there are some tests to make sure that you're eligible. In order to access the concessions through a trust or a company, you need to at least own 20%. So we look at things like that when you're structuring, to make sure that you're owning at least 20% to be eligible for the concession. So I think it's very important when somebody's starting up a business, and now the lifetime of a business can be short as well. It can be, people are selling business within 3 years, 5 years, 10 years, whatever. So when we are looking at the structure, whether it's a trust or a company, we do need to take this into account as well. But we also finding that the space that Sandy and I work in, companies are growing in value so quickly that they're outside the range. So they are no longer eligible. They've gone past the 6 million in a couple of years, or they're well past the 2 million revenue turnover. So obviously we need to watch that. So I think the rules need to get adjusted for that, for the new economy, the digital economy. Dinesh, with all the work that you're doing, your clients will be growing faster. So we need to make sure the law keeps up with that as well. But again, a very important thing to consider, especially for small business. And in this time as well, if you're exiting a business now, it'll be good that you can keep, those dollars in your pocket and fund your retirement. So very important considerations.